Ladies and gentlemen, good day and welcome to Vardhman Special Steels Limited Q2 FY25 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mudit Bhandari from IIFL Securities Limited. Thank you and over to you, sir.
Thank you, Palak. Good afternoon, everyone. On behalf of IIFL Securities, I welcome you all to second quarter and first half of FY25 post-result earning conference call of Vardhman Special Steel Limited. On this call, I introduce Mr. Sachit Jain, Vice Chairman and Managing Director, Mr. Sanjeev Singla, Chief Financial Officer, Mr. R.K. Rewari, Executive Director, over this call. Now, I hand over to management for their opening remarks, which will then be followed by question and answer session. Over to you, sir.
Okay, thank you so much. Ladies and gentlemen, very good afternoon to all of you, and thank you for joining our call today. In addition to the names mentioned, we also have Sonam, our Company Secretary, on the call. We've just closed a very interesting quarter. We've had our highest sales ever in a quarter, so that has been very interesting. We have also just finished a physical board meeting because Ito-san, the board member and president of the steel division of Aichi, was here. And we've had very interesting discussions, and as I said earlier, so serious discussions on our proposed new plant have begun. We are discussing costs, layouts, machinery selection, product mix. All those discussions are going on. I think we'll be ready to make a final announcement sometime in the middle of next year, but that's the thinking as of now. And we are on track with our plans for when we will need our greenfield plant to start operating. In the interim, we've had some very good developments in the plant. Earlier, we had announced that we had tested a capacity of 265,000 tons, which gave us a rolled product capacity and sellable material of about 225,000 tons. We have now tested 285,000 tons of melting capacity, which means that once the rolling mill expansion is completed, we should be able to produce 250,000 tons of sellable material. And now our team is working. Can we extend this further? Our next target will be to test and then consolidate if we are successful at the 300,000, which is the limit for our license from the Environment Ministry. If we are able to reach this level of 300,000 tons, then we will make an attempt to get a license to increase the environment approval for more than 300,000 tons. That's some distance in the future. So the point was that at least once the market orders and all start growing, the plant is keeping ahead and will be able to meet the requirements of the market. And so growth for the next 3 years is now visible to us. In addition, I wanted to also share a very important development. A new board member, Mr. Kalsi, who has been a member of the executive board of Maruti Suzuki, 40 years with Maruti, as well as his last assignment has been head of marketing of Maruti. Overall, he's had a stellar career across several functions, and the entire board is very excited to have him join the board and get a perspective from an OE's perspective. And of course, Mr. Hemant Bharatram from the DCN group has also joined us as a board member last board meeting. So 2 new board members have joined us this year, as 1 board member retired and 2 more board members are expected to retire next year. So in succession planning as a board, we are doing that in a planned manner. Working capital utilization, of course, has increased because of increased sales, but our debt levels remain reasonable, which gives us ability to fund all the ongoing expansion plans. The new proposed plant, when it comes up, will require reasonable capital. So, in the next year or two, there would be some capital infusion in the company. But as the plans get finalized, as we announce the project, then those plans for fundraising, etc., also would come in. We also talked to bankers, so there is sufficient funds available in case of it. All that also seems to be on track. Two other things I wanted to share with you before I turn over to Mr. Singla, our CFO. The trend towards green steel, circular economy, etc., continues to be strong, and indications coming in from various auto OEs about from their sustainability teams, and the interest in this topic and is high. And hopefully the next year or two, we will start seeing big signs of this in terms of translating into business results. Talks are always the forerunner of actual action happening, and we are having serious discussions with some of the OEs. I'm also happy to report that we have been successful in getting approval for replacing Japanese imported steel with our steel in one of the large automobile OEs. And for this, we will become a direct supplier to the OE. As of now, we are normally suppliers to tier 1s and sometimes tier 2s. But in this case, we will become a tier 1 supplier directly to the OE. So this is something I think our team has worked very hard, and our partners, Aichi, have supported us very strongly in getting this approval. So we'll be replacing direct Japanese steel, which is coming from Sanyo and Daido. So we'll be replacing that. We're working with another Japanese OE in India to replace steel coming from India. So from Japan. So those are the kind of efforts going on. As our quality levels have stabilized with Toyota and with support from Aichi, crossing 2 years, crossing 5 years actually, 2 years of the second 3-year term, I think the confidence that they have in our processes also have increased. So that's all as far as my opening remarks are concerned. Mr. Singla will take you through some numbers, and then we'll have a Q&A.
Right, sir. Thank you, sir. Good afternoon, everybody. For this quarter 2, we have a decent sales number. We have achieved our highest sales in terms of quantity. It is 59,000 tons, as against 49,000 tons in the previous corresponding quarter, registering 20% increase. And in terms of rupees also, it's a 20% increase. It is 494 crores over 415 crores last year. Our EBITDA has grown by 31%. It's a combination of various factors, raw material prices, valuations, and of course the increase in sales. So EBITDA per ton in this quarter is 8,200 rupees. For the H1, for first half H1, the total sales in terms of quantity is 109,000 tons, as against 96,000 tons in the corresponding H1 of last year, registering an increase of 13%. In terms of rupees, revenue is 909 crores as against 824 crores, with an increase of 10.31%. EBITDA is 96 crores, registering increase of 31%. So EBITDA per ton for the full H1, currently it is 8,800, well within the stated range of 7 to 10,000. As a result, our PAT for the H1 stands at 51.9 crores, as against 37 crores corresponding H1 of last year. So that's all on this financial performance for the quarter. So I request now for the question answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jane from RU Invest. Please go ahead.
Yeah, hi, good evening. Can you hear me?
Yes, sir, you're
Yes, go ahead.
Okay, hi. Yeah, hi. First of all, congrats. I think we are, every quarter we are having a good result, and I mean the bonus and the plan expansion is all track. A couple of questions. Number one on the micro, the other will be on the macro thing. First is the recent trend of the record, what top line we are talking, we are making new records. Can it be continued? Because the reason is, if I'm not wrong, please correct me, Q3 or Q4 will have a shutdown planned, as always. So that's the question number one. Question two is on our EBITDA or EBITDA per ton. As per the industry standards, we know it's around $8,000, rupees or whatever. But again, the trend, is it possible we can continue or make it higher, considering the latest developments on specifically the latest one is the Trump policy, tariffs on the Chinese and even India, I think, as we have recently heard in the last couple of months, they are trying to put tariffs on steel imports from China. So is it safe to assume that our EBITDA per ton will be moving up for even Vardhman steel or even for the overall Indian steel industry? Thank you.
So one, it's not that every year we have a shutdown in third Q3 and Q4. The shutdown that we are having is for the expansion we are having. We are adding a new equipment called Cox Block, for which we will be having a shutdown which was earlier planned in third quarter, which will go into the fourth quarter. Yes, so we are having about a month shutdown, and which is why sales in the second half are definitely going to be lesser than the first half. In any case, second quarter is the highest sales because the auto OEs all prepare for Diwali sale, which is the bumper sale. So as a steel supplier, for us it becomes Q2. So Q2 is normally the highest sale. But once this shutdown is complete, the Cox Block is ready, then we will have another 5 days shutdown, probably in quarter 2 of next year, 4 or 5 days shutdown, when we attach a new reheating furnace. After that, our rolling mill capacity will be complete, which means it should be able to take 300,000 tons of input, giving us out 275,000 tons of rolled product, which will translate to eventually 268 to 270,000 tons worth of sellable material. The question you asked is about EBITDA per ton. Our stated range is 7,000 to 10,000 rupees EBITDA per ton, and we are within that range. Currently, the markets are weak, as you rightly mentioned, because of imports from China, and therefore there's a huge influx of imports, not in our product category as much, but more in HRCs, hot rolled coils, which puts a downward pressure on steel sentiment, and which is why there is pressure from the OEs to reduce prices. Our costs have also come down, but prices did come down in Q2 beyond what we anticipated. So that's why the Q2 margins are a bit lower than Q1 margins. Moving ahead, once we have already indicated next year our guidance, we should be able to up our guidance from the 7,000 to 10,000 range to 8 to 11. So there are a few reasons for that. One, our solar plant will be commissioned most likely by March, which will lead to one, reducing our carbon footprint, as well as reducing some costs of power. So that is one. Second, today to meet our rolling for our sales, we have a lot of job work outside processing charges because of lower rolling capacity than what we have been selling, and the shutdowns for this project. So after August of next year, these will, so it will come down in second quarter, in Q1 itself of next year, but second half of next year, it'll come down drastically. So those margins will also get added. From that, the profit element of that will get added to the bottom line, and a few other savings we have in mind. So overall, we should be able to very confidently move upwards to 8 to 11,000 rupees EBITDA per ton range. I hope this answers both your questions.
Yeah, thanks. Yeah, and once again, best of luck. Thank you.
Thank you, sir.
Thank you.
The next question is from the line of Angad from Samiksha Capital. Please go ahead.
Thank you for the opportunity. Congratulations on the good set of results.
Sorry to interrupt you, sir. Sir, can you use your handsets, please?
Audible now? Hello?
You're audible, but it's a little muffled. But go ahead, let me try to understand, to hear you.
My first question is on the sale of billets this quarter. We sold around 2,600 metric ton of billets. Should we expect similar trend going forward? And can you throw some light on the realization and EBITDA from billet sales? If you can give a number on that.
Billet sales is not part of our plan. So this is very opportunistic at times when we can't take more rolling, and as I told you, our melting capacity went up. We tested higher capacity levels. So it's just that since we tested higher capacity, we sold it. There is almost zero, there is zero margin on this business. So this is just to make sure that to test our billet making capacity. So we are ready that once the rolling mill is ready by August, or the expansion rolling capacity is ready, and as markets pick up, hopefully next year the markets will be better, then our ability to keep producing and to meet the market requirements would be higher. So this is on and off kind of a thing, and zero margin business. So this is not our, please don't look at this business at all.
Sure. Clarity is helpful. My second question is on the, we are seeing kind of a slowdown in the automobile OEMs. We are reading news on increasing inventory with dealers. Can you throw some light on your end, what you're seeing since you interact with them regularly?
No, so there clearly is a slowdown, both in terms of domestic market. Commercial vehicles are not doing well. Cars are flattish, and tractors are also slow. Two-wheelers, motorcycles are doing well. Also, exports have got affected. So some of our sales to exporters have got a bit affected. So market conditions are not too bright, but that's why I said we hope market conditions will be better next year.
So, are we still giving the guidance of 2.1 lakh volume sales for FY25, or any change in that front?
Yes, as of now, we expect to do about 2.1. That's our thinking. But we'll see as things go along. It may go a little lower. But see, we are not too worried about sales just now because our products are moving in the right way. And just now we are also capacity constrained in our rolling side. So once rolling mill capacity comes up after August, then of course volumes become an important issue into the market.
Sure, clarity.
There's a big shutdown coming, as I said.
Yeah.
Yeah, because the shutdown of 30 days, if sales slow down a bit, we are not worried just now.
Sure. And one last question on any updates on the forging plant along with the greenfield?
No. See, with our Japanese partners, please understand that a lot of planning, visitations happen, and decision making takes its own time. So nothing on the anvil immediately.
Thank you. I'll get back in the queue.
Thank you, sir. The next question is from the line of Radha from B&K Securities. Please go ahead.
Hello, sir. Thank you for the opportunity, and congratulations on achieving the highest sales for this quarter, all-time high. So my first question was this COGS block capex that you mentioned. So how much capex are we doing in this, and what will be the benefit that we receive out of it? So apart from reducing the time for shifting the sizes, can it also bring down the wastage?
So we have two major investments coming up. The COX block and the reheating furnace together is going to cost us about 160 crores. The main benefits after this capex are going to be the following. One, our capacity will go up, and therefore we will be able to save all the margins on the outside rolling. So that will immediately get added to the bottom line. Second, our billet size will go up, so our realizations will go up, our yield will go up. Third, with the COPS block, our inventory levels will come down, and our ability to serve the customer will become better, and quality will become far more precise. So some of the approvals that we have got recently, they want very precise diameter control. That is not possible without a COPS block. So the kind of market segment we want to enter into and consolidate our position in, they require very precise diameter control. That is not possible without this kind of a block.
So how much margins can we expect improvement, maybe in terms of broad ballpark percentage?
As I've said, that our range from 7 to 10 is likely to move up to 8 to 11. So once things consolidate, we will give further guidance. And I've already said in the past, aspirationally, I want to move to 10 to 12,000 rupees range.
Okay, so what could be the payback period for this investment?
In the next three to it's not 10 years later, but in the next 3-4 years, we want to reach those levels.
All right. So if you just see your investment in the COGS block, so what could be our so just considering the investment in the COGS block and the benefits that you stated, so what could be the payback period from this investment?
We don't look at these things in that manner. Overall, if we are able to increase our volumes, and if we are able to, so look at it this way, from 210,000 tons, we were able to go to 250,000 tons, that's 40,000 tons more. And a lot of costs already taken into account. So incremental EBITDA is way higher than the existing business. So you can please do your calculations yourself. So on 10 to 12,000, we are targeting. I'm not saying we are ready to announce that we are confident of that, but our target will be around 250 crores of EBITDA.
All right. So second question is that you spoke about.
Let me re-emphasize. I'm not giving a guidance that we are ready at that level, but I'm saying that's the target we will aspire for.
All right, sir. Second question is that you spoke about becoming a tier 1 supplier to the OE from a tier 2 supplier. So, and also you spoke about winning, you're in talks with some other OE also. So, currently, as I understand, is our direct supplies to OE is zero because we are a tier 2 supplier. So, in future, next 3 years, what percentage of your sales do you expect to go to the OE? And will this also have an improvement in your margin profile?
So very few OEs have their own gear making operations. So mostly OEs business is all buying components and assemblies from tier 1s. So steel companies of our kind, which is alloy steel companies for forging industry, are normally always tier 2 or tier 3 suppliers. This is one of the very few cases. So as a percentage terms, it will be a very small one. But from prestige point of view, it is very high. And yes, margins will improve with this business.
All right, sir. So third question is that in this quarter, I can see that our receivable days have increased. So in FY24, it was around 58 days, that has gone up to 64 days. So just wanted to know why the increase in this quarter in the receivable days.
The increase in this quarter is because there's an overall slowdown to maintain volumes. We have gone to certain other segments which are non-strategic customers where outstandings are higher. And that is the reason. This is a temporary thing. Once the markets, our regular markets pick up, then we will be back to our normal level.
All right. So in this all-time high quarterly volumes that we have done, how much of it has been outsourced?
The job or quantity, value. We'll get back to, can you send a mail? We'll get back with the answer. That exact figure is not available out here.
Okay, sir. So because our volume growth is higher than is significantly higher compared to the auto industry growth. So as
I said that we had tested higher capacity, and therefore we took in orders which are not part of our regular order profile at lower margins, and those with higher outstandings also. This is not our regular product mix. So this is a temporary thing to sell what we could produce. So this is not part of our regular product mix. So which is why we have grown beyond what auto industry has grown.
Mm-hmm. So our user industry mix in this quarter would have changed compared to the previous quarters, and what it will pay back to previous level.
If we hadn't done what we did, our sales would have been lower and EBITDA per ton would have been higher, and our outstanding would have been lower than what we have today. But absolute EBITDA would also have been lower.
Mm-hmm. Understood, sir. So lastly, in future, any investment decisions?
May we request that you return to the question queue, please?
Okay, ma'am. Thank you.
Thank you, ma'am. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Mudit Bhandari from IIFL Securities. Please go ahead, sir.
Sorry, I have the answer now. So 9 crore rupees of job work has been done in this quarter. So that was an answer to how much money has been paid for outside job work. Go ahead. Next question, please.
Mr. Mudit, your line is unmuted.
Thank you, sir. Just one first basic question on what is the difference between tier 1 and tier 2, tier 3 suppliers in general with the industry regarding the product they are supplying, and what incremental product will be supplying which will be classified as tier 1 supplier for the OEM?
So normally tier 1 suppliers would be gear manufacturers, crankshaft manufacturers, connecting rod manufacturers, piston pin manufacturers. So basically our customer base are the ones who would be tier ones or steering systems. So people like Sona Comstar, they would be tier ones, or Shriram Piston would be a tier one, or a highway industry would be tier one. These companies who are forging and machining companies would be tier ones, and steel companies are normally tier twos, or in some cases tier threes. So in this particular case, this OE has their own gear shop. So they have their own gear making rather than getting these gears made from outside. So therefore they buy steel. So this is a unique case of OE directly buying steel. So the difference is, in this case we are supplying steel to the OE. In other cases the OE buys gears or connecting rods or crankshafts or pistons, pins, and so on, those kind of products.
Yeah, got it, sir. Got it. Thank you. And previously you mentioned that there has been a little impact because of the global commodity prices, especially because of China effect on of us. The reason you mentioned was it has more impact on HRC prices. So I believe we are not completely immune to the HRC prices because our process...
No, we are not immune. No, I never said we are immune. I said we are not directly affected by imports, but sentiments got affected because of lower prevailing steel prices, and therefore the OEs pressed a higher reduction than what was, in our opinion, due, and therefore our Q2 margins are lower than Q1 margins.
Got it, got it. And any number?
But still within our normal range. I'm sorry?
And yes, so any number which you would like to quote for realizations for Q1 and Q2, either percentage or numbers?
Realization. There was a 1,500 rupee. There was a 1,500 rupees per ton reduction in price between Q1 and Q2.
Okay.
So from 1st July, prices came down by 1,500 rupees.
Okay. And we have not taken any price hike or decrease after Q2 in Q3.
Yeah, Q3 has not yet been finalized.
Okay. And how does it work for the auto components? Like whether they fix the prices as far as I know for the half yearly basis. Is it like that or?
No, this is quarterly changes of steel prices.
Okay. Okay. Got it. And lastly, upon your EBITDA per ton guidance, the range you mentioned the reason you mentioned for the increase was because of solar plant commissioning. So broadly, just whether 1,000 rupees EBITDA per ton increase is wholly attributable to solar plant commissioning? The number seems quite a big.
No. I said there are several factors, including these factors.
Oh, okay. So probably I missed it. Can you just quote the factors?
So solar plant is one. The outsourced material that we will be rolling within the plant, the job work charges that I mentioned, 9 crores per quarter of this quarter. So those would all largely become in-house. So there will be the margin part of that will get retained in the company. Then our yields will go up because of bigger billet size. Those are the main benefits, and some benefits of costs which have to be trialed. I mean, we anticipate some benefits coming because of the cost block also in terms of cost saving. There will be inventory reduction because of the cost block, but we believe there could be some improvement in yields because of quality improvements, but those have to be tried. We cannot commit on those figures.
Okay, got it. Thank you so much.
Thank you, sir. The next question is from the line of Pramod Kumar from Growell. Please go ahead.
Hi, sir. Thank you for the opportunity. So just a couple of bookkeeping questions. What is your cost of funds, sir, if you could help us with that, or your cost of borrowing?
Can you repeat that? Sorry.
So what is the rate of interest that you are paying for the amount that is borrowed?
So working capital is around 7.5 and term loans are negligible.
Right. So the reason I asked
So,
is,
but whatever term loans are there are around 8%.
right. So if you look at FY24, we were about 10% rate of interest, and if you look at the first half, the rate of interest is coming to around 7.5%. So, like, how is it that we got a reduction in our rate of interest?
10%. We've never borrowed at 10% in my last several years. I don't remember borrowing at 10%. So please check with the CFO directly if you have a clarification. You've never borrowed at 10%. Okay.
No, sir.
Yeah.
Okay,
Next,
so
please.
it's first.
I'm saying you've never borrowed at 10%. If you have a clarification, please have separately offline check with our CFO. He'll be happy to clarify whatever doubt you have.
Sure, sir. I'll do that. And in terms of the aspiration of your debt to equity, what range would you be more comfortable with?
Debt to equity currently in the new plant, in this plant, unless the expansion comes up, will be down to 0 in the next 3 to 4 years. So with the new plant, once things get farmed up and the capital structure of the new plant come up, then there will be borrowing, there will be some equity. Overall, we hope to remain below 0.5:1. And in any case, below 1:1. But our target will be below 0.5:1.
Fine, sir. Thank you so much, sir.
Thank you, sir. The next question is from the line of Hardik Shah from Patel Family Office. Please go ahead.
Hello.
Yes, sir.
Hi, am I audible?
Yes, go ahead, please.
Hi, sir. Congratulations on this all numbers. So, I just wanted to ask a basic question, like, what percentage of your revenue is generated by your top 10 clients?
Very difficult. We are very diversified, but go ahead.
But just top 10 customers, I think we are disclosing in our balance sheet for the top 5 customers. But as per your question, more top 10 customers will be contributing around 35 to 40% of our revenue.
Okay, sir. And any expectations for that to change?
You can specifically send in an email to get an exact answer.
Yes.
But
Sure, sir. I'll get in touch.
we don't target it this way. We don't target these things this way. We take all markets. We don't target a specific number or a range for the top 10 customers.
All right, sir. And also
It's not a
wanted to
metric.
know. Yes, sir.
I'm just saying this is not a
Understood.
metric that we monitor at management level. As long as it's diversified, it's not too concentrated.
Understood, sir. And so, secondly, what is, on a financial front, what is the benefit that we are getting from, any step towards a sustainable initiative, like for the reducing the carbon footprint?
As I said, as of now, there is zero benefit, either in terms of financial or in terms of business, which already we have got. But in terms of indication we are getting from customers, and indications we're getting from government and in talks with governments, both will follow. So there will be financial benefit in terms of carbon trading mechanism coming up in the country. Element is being fixed that a limit of around 2.2 carbon footprint tons per of carbon per ton of steel is going to be fixed as the norm. So the figures below 2.2 will be treated as green steel, or there will be some definition, but we will be at by then 0.45, so significantly below 2.2. So we will be beneficiary of any scheme that the government comes up with. Secondly, as terms of as far as OEs are concerned, whether it is the large European OE that we talked about earlier, which is looking at buying from us, they've come to us purely because of our lower carbon footprint. So what I feel is that this will lead to better business, better quality business coming from car manufacturers which is a better business than two-wheeler manufacturers, which is a better business than commercial vehicles, which is a better business than tractors. That is the hierarchy. The best, the most stringent, and therefore overall better business is the car manufacturing. So our target is to increase our car segment from currently 38% of sales to about 50% of sales in the next few years.
Understood, sir. That's very encouraging. And so one last question is that, so basically what would be our repayment plan for the short-term borrowings as it has kind of increased in the last few quarters?
There is no repayment plan.
Okay.
As cash flows come, we pay, and as we need money, we borrow, because we have a capex plan, no? We have a 300 odd crore rupees capex plan ongoing for the existing plant. So cash is required for it. So that is money coming in and money. So when LCs are open for equipment, then we will have a borrowing coming in at that point in time.
Understood. So one last small question. So what is the interest rate on it, on the short-term borrowings?
7.5%, around that.
Fair enough, sir. Yeah, that was the last question from my side. Thank you so much, sir.
Thank you, sir. Before we take the next question, we would like to remind participants that you may press star and 1 to ask question. The next question is from the line of Adit Shah from Metur Wealth Management. Please go ahead.
Hello, sir. So I just wanted to know, is there any update on any current or upcoming capacity expansion from the company?
So we've said that our plant capacity was 285,000 tons, which we have tested. So we are now in a position to make 285,000 tons of billets. As far as the rolled production is concerned, the rolling mill expansion is in place, and by August we should be ready. Let's add one more month of stabilization. The second half of next year, our capacity will be on track, which is 300,000 tons of billet input, which means 270,000 tons of rolled product. So this will be in place by September of next year. Then we have said that we will target to reach towards 300,000 tons of steel making, which can then be fed entirely into our rolling mill. But 285,000 tons, which was our capacity, has been tested, and now we don't sit still, so we try for the next level of 300,000 tons.
Okay, sir. And one last question. I just wanted to ask, what is
I'm repeating. Sorry, I'm repeating that let it not be misunderstood. We will be trying to reach 300,000 tons.
Trying to. Okay, sir. Okay, that's where August is.
Yeah, right.
Yes. Noted. And one last question, sir. What is the company's strategy for securing raw material supplies, especially given in this volatile prices for critical inputs like iron ore and scrap?
So we don't buy any iron ore. We buy scrap, and scrap is we have a long-term arrangement with one of the shredded scrap producers. And other areas, as the circular economy becomes more and more prominent, and as we are learning from OEs, this is what they are moving towards. We should be able to secure scrap directly from the OEs. But this is something that is being talked about, nothing concrete on the ground. Further, we are looking at the possibility of having some strategic investments in some scrapping companies, because scrapping companies' plants are coming up across the country. So we are examining any such opportunity of doing that, taking a minority stake. So we don't intend to get into that business ourselves, but a minority stake, if it comes up, is something that we will very positively look at.
All right, sir. And just one generic...
Scrap availability is not a problem.
Okay. And just one last generic question, sir. How do you see the industry going forward for the next 5 years?
I think the industry will move more and more towards companies like us, because of carbon footprint and green steel, and pressure from the government to use more recycled material. So as of now, I think compared to all our competitors, we are by far the best placed in terms of lower carbon footprint and the necessary approvals in place. So having both these factors, and with the Japanese collaboration and the reputation for quality and reliability that we have, so those things give us an edge. So I'm focusing constantly on seeing how we can continuously increase our four-wheeler business, so the car business. That's what we are targeting.
Very good. All right, so that was very helpful. All the best.
Yeah.
Yes, sir. Yes. Thank you.
Thank you, sir. The next question is from the line of Radha from B&K Securities. Please go ahead.
Hi, sir. Thank you again for the opportunity. So my first question was, in the next 2 years, we are expecting a single-digit volume growth, and this is primarily because of the capacity constraints that we have. So I was wondering that why are we doing growth capex in a slow manner? So in future, for growth capex or for fast-tracking the current capex plans, do we need to take approvals from our Japanese partners, or do we have the independence to make such decisions by ourselves?
So first of all, we don't need approvals from from our partners. But look at it this way: when you have the world's, arguably, in my opinion, the world's best company in a business, would you not want their full involvement and full participation and full inputs into the whole thing? So they are fully on board, and they are the whole process of discussing what products to make and so on. So this is one part. So they are fully on board. The second part is that this is not a business where you can expand in a modular manner. The new plant will suddenly come up with a capacity of 350,000 tons. So you have to be very careful and so when we are seeing the trends, as this approval from this OE has happened, this gives a lot of confidence. As this trend towards green steel is gaining steam, as this approval from the European OE comes through, it is at the final stages, but as it comes through, as this circular economy becomes a bigger and bigger concept, and as the government comes out with clear regulations of carbon trading, so all these things are very positive factors which are supporting our growth and which will enable us to take this decision. So as I said, planning is going on. So and I've already said that next year we should be ready to announce. You can't go faster than that.
Okay, so just continuing with this question.
In the existing plant, we are continuously increasing our capacity, by debottlenecking, by taking trials and testing. So just a few months back, I said we have tested a capacity of 250, then we said 265, and today I'm announcing that we've tested 285. So we are gradually increasing our capacity.
Understood, sir. So just continuing with this, for supply to IC group, I understand that we need IC approval. However, for supplying to non-IC customers, do we also need their approval? So I just wanted to understand, are they only investment partner and customer for us?
We don't need any approval.
What is?
No, we don't need any approvals from them. We are selling to all customers, including Hyundai, which is a Korean company, and to all Indian OEs and to other Japanese OEs in India. And I've already said that we are at advanced stages with the European OE for supply of steel to them for a very specialized project. So all these discussions are going on. So they are fine because everybody wants this company to grow and become stronger.
Understood, sir. Thanks, and all the best to you.
Thank you, ma'am. The next question is from the line of Sana Mehta, an individual investor. Please go ahead.
Hello, good afternoon, sir.
Yes, good afternoon.
Sir, my first question is, despite a decrease in steel prices, the cost of raw materials per ton has gone up in comparison to the previous quarter. So could you explain on that, please?
So those factors keep changing here and there. There are also inventory valuation losses because the prices have come down. So those are, so any specific question, please direct to our CFO as an email separately.
Sure, sir.
Normally, we don't answer such questions because there's a mix which changes also. It's not a standard mix which is constant. So, and various components of raw material, the prices are different. So sometimes prices may go up of raw material and other costs may come down. So it's a very complicated and complex factor. It's not just one raw material leading to one particular thing.
Okay. Sir, and the other question is, what is the revenue split between bright bars and rolling mills?
Bright bar is roughly about 20% of our total sales.
Okay, sir. Noted. Thank you, sir.
And it's rough because these figures keep changing depending on which particular customer orders have come through and so on. So that's the rough idea.
Okay, sir. Okay.
Thank you, ma'am. The next question is from the line of Aniket, an individual investor. Please go ahead.
Hello, sir.
Yes.
Yeah, thank you for the opportunity. I have a few questions. So, sir, just wanted to understand, can you throw some light on this, the activity that we are doing with the solar panel installation?
So we have a joint venture because under the government policy of a group captive power plant, so we own 26% in this power company, which is, and the implementer is a company called Amarenco from France. They own 74% of the company, and they are implementing a project which will be about 55 megawatt. They have assured us that by March of next year, hopefully we will get, the plant will be commissioned and we'll be able to get solar power, which will be roughly 45% of our total power consumption.
Okay, okay. And sir, by when will it start having a positive impact on our controlling our cost?
So if it gets commissioned by March, from April we'll start getting benefits.
Okay, okay, okay. So
yes, there is no stabilizing period in this. So it's on off. Either you're getting a benefit the moment it's commissioned, from next day we start getting the benefit.
And what is the contribution in terms of revenue from domestic and export?
Our exports are roughly 5 to 7%. It varies, but our target is to eventually move to 20%. Currently, because of Chinese dumping, the prices are low, so not many people are wanting to buy more from India. And Japanese currency is also weaker. So the cost advantage in buying from India is not as much. But so gradually, slowly, we are progressing and increasing our exports into Southeast Asia primarily.
Okay, okay, okay. And sir, how do you...
Go ahead.
Yeah, go ahead, sir. Sorry.
Go ahead, please.
Yeah, so sir, how do you plan to expand your reach in the coming years, especially with the plans of this new capacity?
So one, we will make deeper inroads in the four-wheeler, as I said, from 38%, we want to move to 50%. With the growth in the Indian economy, the expectation is that the automobile industry itself is going to become much larger. In fact, Maruti Suzuki plans to double its capacity to 4 million cars per year, 3 million for the domestic market and 1 million for exports. That is what I think I've heard from their people. So with the increase in Maruti Suzuki, with the increase in the two-wheeler companies, and four-wheelers, commercial vehicles will eventually come back. And then exports of auto components from India because of CBAM coming in. So there are massive opportunities. Then you look at Southeast Asia with this new plant coming up, the limitations of our existing plant will go away, which means that the quality levels will improve further from the current levels. We'll be able to make more stringent quality than what we're able to make today, and which will mean that there should be bigger export opportunities in Southeast Asia. And eventually, as Africa opens up for Toyota and other companies, those possibilities of making components in India, people would make and export to Africa, those opportunities will open up. So, because new plant, by the time it comes up, will be 5 years from now. So we are talking about now. So the market scenario is going to be way bigger. Indian economy is going to be way bigger. So there will be many opportunities. We'll also look at other segments like railways. So there are other segments to start examining.
Okay. Got it. And sir, one last question.
Again, those are all. Sorry, again, let me repeat. Those all are all things that we will examine, we'll study, and so on. So no major commitments at this stage, because this is 5-10 years in the future.
Correct. So, sir, one last question. So, are there any government subsidies or incentives being leveraged for this solar panel installation?
Not to my knowledge.
Okay, sir. Thank you so much. This is from my side.
Thank you, sir. As there are no further questions from the participants, I now hand the conference over to Mr. Sachit Jain for closing comments.
So, ladies and gentlemen, thank you again for the interest you've shown in the company. I am repeating that currently the market conditions are not that bright, and we are coping as best as we can. And the hope is, as all of you know, with Trump coming in, hopefully if the war stops and if the mood starts changing next year sometime, we will see a much brighter situation. And we are ready for that in terms of the capacity expansion we're putting in place. So we'll be ready for any such requirement as it comes up. I remain optimistic about the medium and long-term future. The current situation looks, as all of you know, the auto industry is currently not too great. So I remain optimistic as always. And we should come up in the next 6 months, we will come up with a more concrete announcement about our new plant. But thank you so much for being here today.
Thank you, sir. On behalf of IIFL Securities Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.